What really happens before a financial crash? The 2008 crash wiped out $8 trillion in wealth. The dot-com bust destroyed $5 trillion. The 1929 panic erased 86% of the stock market's value. And the 2020 market panic erased gains almost overnight. Every time, the average person was caught by surprise. But the signs were already there. Rising costs, job insecurity, sudden credit freezes, and housing instability had already started affecting real people. The crash didn't start on Wall Street. It started in households, in empty savings accounts, in overdue rent notices, in people taking on second jobs just to afford food and gas. The big changes don't start with market charts. They start with pressure you feel every day. And when that pressure starts stacking up from all directions, history tells us we're getting close. In this video, we're going to break down the real signals that show up before every major financial crash. The kind you can feel long before you read about them. And if you can spot them in time, you won't just protect yourself. You'll move into a stronger financial position while others are still reacting. Because by the time it becomes obvious to everyone, it's already too late. One of the most overlooked early signs is the rising cost of basic living. When people start cutting back, not just on luxuries, but on everyday essentials, that's a red flag. Today, groceries cost more than they have in years. Rent prices are eating up larger and larger chunks of people's income. And even middle-income earners are finding it difficult to save anything at the end of the month. These aren't abstract economic indicators. These are the day-to-day realities for millions. When the price of food, utilities, transport, and rent rise faster than wages, households get squeezed. And when households get squeezed, the broader economy starts to feel it. According to recent surveys, nearly half of Americans can't cover a $400 emergency without borrowing or selling something. That's not just a personal finance issue, it's a systemic vulnerability. When people don't have savings, they're one unexpected bill away from financial distress. Multiply that by millions of households, and you have an economy that's more fragile than it appears. Crashes don't begin with headlines. They begin when large groups of people quietly begin to run out of financial cushion. Another clear signal is the growing reliance on credit to maintain a normal lifestyle. Credit card balances are at record highs, and interest rates on that debt are becoming harder to manage. People aren't borrowing to invest, they're borrowing to survive. Buying groceries on credit, paying rent with borrowed money, stretching one paycheck into the next by floating balances. This behavior usually starts subtly and becomes more common right before a crash. It signals that people are no longer living within their means. Not because they're reckless, but because costs are rising faster than incomes. At the same time, job security starts to fade. It doesn't always happen with mass layoffs at first. It often starts with job openings slowing down, hiring freezes, or shifts in hours and contract terms. People find themselves working the same job but for less. Fewer hours, smaller bonuses, more performance reviews. Companies become more cautious. You hear more stories about people picking up side jobs, freelancing at night, or starting delivery gigs just to fill income gaps. This growing instability in employment is one of the quietest and most dangerous signs that a downturn is near. Then there's housing. Rent increases are pricing out tenants. Home buyers are delaying purchases due to higher interest rates. Homeowners are seeing their mortgage payments go up if they're on variable rates. All of this slows down the housing market. And when fewer people buy homes or move, it affects a long chain of industries. Construction, furniture, appliances, materials, real estate services. Housing isn't just where people live, it's a foundation for consumer spending. And when it weakens, it creates ripple effects across the economy. Meanwhile, you'll notice a shift in how people talk about money. Conversations that used to be about growth, goals, or travel slowly turn into talk about cutting back, holding off, or just getting by. You see more online content about budgeting, downsizing, or dealing with burnout. Friends and family talk about bills more than plans. This cultural tone shift is often a better predictor of trouble than economic forecasts. When the general mood becomes cautious, it's a sign people are already feeling the pressure. At the institutional level, you'll see banks start to tighten lending. This means it becomes harder to qualify for loans, whether it's for a home, a car, or a small business. Approval requirements quietly get stricter. You'll hear stories of people with good credit being denied. Businesses struggle to get financing. Credit dries up not because there's no money, but because lenders are bracing for risk. And when businesses can't borrow, they stop expanding. That's when the job market starts to contract more aggressively. You might also notice more government messaging about controlling inflation, stabilizing the economy, or encouraging saving. These announcements often come when underlying conditions are already strained, but the policies usually take time to work. if they work at all. For everyday people, this means prices remain high while wages stay flat, and financial stress continues to build. By the time policy adjustments take effect, the damage has often already spread through the system. Another overlooked sign is a slowdown in small business activity. You'll notice more shops closing early, fewer new stores opening, and service quality dropping. These aren't always directly tied to the stock market. They're signs that spending is slowing down. When people spend less, businesses shrink or shut down. This in turn reduces employment and community-level income. It becomes a cycle. Local economies feel it first, and if enough of these communities struggle at the same time, the national picture starts to change. Real estate agents will start saying houses are sitting on the market longer. Car dealerships offer more aggressive financing deals. Subscription services start emailing discounts and promotions more often. These little signals tell you demand is slowing. Consumers are pulling back. Companies are trying to keep revenue flowing in a cooling environment. And eventually that cooling becomes contraction. You'll also hear more people saying they feel like they're working harder and getting less in return. That sense isn't just emotional, it's backed by the numbers. Real wages, that's what your income is worth after inflation, have been shrinking. People are doing the same jobs, sometimes even more, and yet their money buys less. That creates fatigue, dissatisfaction, and eventually less economic activity. Because when people feel stuck, they stop spending on anything beyond the essentials. These slow-building stresses are what lead up to a financial crash. Not flashy news, not sudden collapse. It starts with everyday people making tough decisions, holding off on medical visits, canceling plans, delaying car repairs, taking loans from friends, selling things online. It's not dramatic, but it's widespread. And when millions are doing this at the same time, it points to an economy that's losing momentum, even before the market data confirms it. So how do you prepare for something like this? First, you protect your basics. Make sure your emergency fund is as strong as possible. If you don't have one, start with any amount you can put away consistently. Even $10 a week adds up. Second, reduce your reliance on debt. If you're carrying balances, focus on paying off high-interest loans first. This lowers your monthly pressure. Third, build income security. This could mean learning a skill that makes you more valuable at work, starting a side hustle, or diversifying your income streams. Also, watch your expenses closely. Cut back before you're forced to. This gives you breathing room. Review subscriptions, unnecessary upgrades, and habits that drain your money. Finally, stay informed, but not reactive. Don't let panic drive decisions. Use information to make steady improvements in how you earn, spend, and save. Crashes don't just wipe out money. They expose weak financial foundations. But they also reward preparation. The people who come out ahead are the ones who read the signs early and took quiet action. So, while most are watching the headlines, pay attention to what's happening around you. At the grocery store, in your neighborhood, in your own wallet.